Welcome back to The Sensible Investor, the podcast where we try to make sense of the sometimes senseless world of finance. I'm your host, Kate. Today we have our resident market analyst, Mark, back with us. Mark, always good to have you.
Great to be here, Kate. I actually just came from a Costco run, so I'm fully stocked on coffee and existential dread about my credit card bill.
A universal experience. Which brings us to our topic today, the store itself. We're talking about Costco Wholesale, ticker COST. This is a company that people don't just shop at. They are fiercely, almost cultishly loyal to it. It's a cultural phenomenon disguised as a warehouse. I can't remember the last time I went to Costco and it wasn't absolutely packed. It took me 20 minutes to find parking last time.
You know it's by design. Costco is very intentional about how it opens new stores. Before building a new store in a new location, they study the area for 3 to 5 years and learn everything there is to learn about the place. That's why they always pick the perfect spot and all their stores are full all the time. The company is very slow and strategic about opening new stores to ensure that every store is fully utilized.
I'm not surprised. But does that intense loyalty translate into a sensible investment at its current price? Mark, let's start with the bull case. What makes this company so special?
The bull case for Costco is a business school masterclass, and it all starts with the membership fee. People think they're a retailer, but it's more accurate to call them a membership club that uses high-quality, low-priced goods as the benefit of membership. In their last fiscal year, they collected over $4.8 billion in membership fees. That's almost pure, high-margin profit, Kate. It's this river of cash that allows them to sell everything else at razor-thin margins. What's even more telling is the psychology of it. Once you've paid that $60 or $120 fee, you feel a sunk cost. You want to shop there to get your money's worth.
So the fee itself drives engagement, and that engagement is reflected in their renewal rates, which are famously high.
Astoundingly high. They consistently hover around 93% in the US and Canada. That's a subscription renewal rate that streaming services would kill for. It shows an incredible level of satisfaction and creates a predictable, stable foundation for their entire business model. It's an economic moat made of pure, unshakable loyalty.
A big part of that loyalty is tied to their house brand, Kirkland Signature, which people seem to trust implicitly.
It's their secret weapon. Kirkland accounts for nearly a third of all sales, and it's a brand built on a promise of quality that often exceeds the national brands it replaces. The secret is that many Kirkland products are made by the top-tier companies themselves. Think Duracell making the batteries or Starbucks roasting the coffee. Customers get a premium product without the premium brand name price, which builds incredible trust. This is all part of their second major strength, the treasure hunt shopping experience.
That's the feeling when you go in for milk and come out with a 7-foot-tall teddy bear and a new set of tires, right?
Precisely. A typical supermarket has 40,000 different items or SKUs. A Costco only has about 4,000. This limited selection gives them immense buying power. They can go to a supplier and offer to buy their entire inventory of a product. This allows them to get incredible deals on high-end, limited stock items like a new set of golf clubs, a designer watch, a pallet of Japanese Wagyu beef that are there one week and gone the next. It creates a sense of urgency and discovery that makes shopping there an event, not a chore. It's a brilliant merchandising strategy that drives repeat visits.
And the growth story isn't just domestic. They have a long runway internationally, don't they?
They do. They've proven the model works in diverse markets from the UK to Japan and Taiwan, where they have a fanatical following. The recent store openings in new markets like China and Sweden have been near riotous events with massive crowds and traffic jams. This shows they have significant room to grow abroad where they are far less saturated than in North America.
I remember seeing the store they opened in China. They said that people had to line up outside and wait for up to 4 hours just to get in the store.
Lines went for miles. It reminds me of Black Fridays we had before the internet era.
Okay, that's a powerful bull case. But the stock has had a huge run and trades at a valuation that can only be described as rich. Let's talk about the bear case.
You hit on the number one issue, valuation. As of today, Costco stock trades at a price-to-earnings ratio of over 45. For comparison, a competitor like Walmart trades at a PE closer to 25, and the S&P 500 average is around the same. Even looking at a price-to-sales ratio, Costco is trading at all-time highs. You are paying a tech company price for a retail company. The stock is priced for utter perfection, meaning you're essentially paying today for growth that you hope will happen 5 to 10 years from now. It leaves absolutely no margin for error.
And in today's world, that perfection is threatened by the ever-present Amazon.
Exactly. That's the second major risk, e-commerce. Let's be honest, Costco's website and app feel like they were designed in 2005. They're clunky, difficult to navigate, and offer a poor user experience compared to the seamless one-click world of Amazon. While they made a smart acquisition of Innovel Solutions a few years ago to handle last-mile delivery for bulky items like furniture and appliances, the core digital experience remains a significant weakness. The bear case argues that while the in-store experience is currently king, the relentless convenience of online shopping could eventually begin to chip away at their armor.
That brings up an interesting point about demographics. Is the Costco model, which seems to rely on big, suburban homes with lots of storage space for bulk items, at risk with younger, more urban consumers?
That's a very real long-term question. The buy a year's worth of toilet paper model works great if you have a two-car garage. It doesn't work so well if you live in a 600-square-foot apartment in a dense city. Competitors like Target have been very successful with smaller format stores and trendy brand collaborations that directly appeal to a younger urban demographic. The rise of on-demand delivery culture with Instacart and DoorDash is the philosophical opposite of Costco's plan ahead and buy a ton model. There's a risk they could be slow to adapt to a potential shift in how the next generation wants to shop.
So, to summarize the bear case, a sky-high valuation, a lagging e-commerce presence, and long-term demographic questions. What's the final takeaway for a sensible investor looking at Costco today?
Costco is, without a doubt, one of the highest quality businesses an investor can own. It has a durable competitive advantage, a fanatically loyal customer base, and a brilliant business model. The recent CEO transition from the legendary Craig Gielan to Ron Vatras, a 40-year company veteran, appears to have been seamless, signaling a stable continuation of their successful culture. The question isn't about the quality of the company. It's about the price of the stock. Buying Costco today is a bet that this exceptional business will continue to execute so flawlessly that it can grow into its very expensive valuation. It's likely one of the safer long-term bets in retail, but because the price is so high, the potential for market-beating returns from this point forward may be limited. It's an investment for someone who prioritizes capital preservation and predictable, steady growth over high-flying returns.
So, the investment might be less exciting than finding that paddleboard in aisle 7.
Exactly. For new investors today, buying the stock is like buying the pallet of paper towels. It's sensible, it's safe, but it's probably not going to be the most thrilling part of your portfolio.
Perfect analogy. Mark, thank you for breaking it all down with such detail.
My pleasure, Kate.